Hi, I'm Miranda Carr, Chief Investment Officer at the Trust Company of Tennessee, and I'm going to be covering data from the second quarter of 2026. It was a positive quarter across asset classes. Interest rates rose slightly, but due to the higher coupon rate, the total return for even treasuries was positive, and spreads came in a bit as well, which produced higher returns for bonds with higher risk. Equities had a very strong quarter. We saw positive headlines surrounding the war in Iran potentially winding down, which supported global markets. We saw positive earnings growth. And even abroad in emerging markets, we saw strong results from semiconductors and technology companies in markets like South Korea, Taiwan, and other emerging markets. REITs also got a boost from the positive sentiment as improved fundamentals in office and lodging came in, and then commodities were down on a big sell off in energy markets and precious metals. I like to remind you and ourselves that earnings growth is what drives markets over the long term. If we think about the value of any company, it comes down to the earnings power of that company, and the index as a whole is driven by the earnings of those companies in the index. And overall, earnings growth has been quite strong. Double-digit earnings growth is typically seen as very positive, and 20+% earnings growth is pretty phenomenal. It is true that a small number of companies are having extreme growth, which is pulling the overall number up. But if you look at the chart in the bottom left, it shows earnings growth for the Magnificent Seven and the remaining 493 stocks in the index. And you can see that while earnings growth for the Mag 7 hasn't really slowed down, the rest of the index has picked up. So we have certainly benefited from this broadening out, and we think that there's still a lot of reasons why this should continue. Of course, one of the risks to the outlook is the war in Iran. Oil has spiked on the disruption in supply, and the world had a lot of stockpiles of oil before the conflict, which has helped cushion the impact of the Strait of Hormuz being closed. We have largely drawn down and used up those inventories, though, so a prolonged conflict from here would most likely have a bigger impact on the price of oil than we've seen, given that cushion is mostly gone. And while energy costs are a much smaller percentage of income for Americans than in the past, we still have that price per gallon of gasoline in our faces. It still impacts our view of future inflation. You can see the expected inflation on the top right in orange. It's moved pretty much in tandem with the price of oil since the conflict began. And unfortunately, inflation expectations actually drive inflation outcomes. So it tends to be a bit self fulfilling. So that's something that we're watching. However, there aren't any current signs of recession. The economy grew by about 2% in the first quarter and by 1.5% in the second quarter, with a lot of support coming from business fixed investment. So the AI build out is contributing to real economic growth as we build data centers and as businesses invest in and adopt new technologies. So I'm sure there's more to come on that. Inflation has still been problematic. And unfortunately, with inflation, once the cat is out of the bag, it's hard to reverse course. And policy has consequences. So we did see inflation trending down after the post COVID supply demand imbalances came back. And then, of course, the Russian invasion of Ukraine caused energy to spike and flow through other parts of the economy. Shelter inflation has been particularly sticky, and you can see the effects of other policies which have either raised the price of goods or reduced the supply of labor and driven up service costs. And that brings us to the part of the chart where we see another spike due to rising energy costs. So it's been quite the battle that we've been losing with inflation. Historically, the prescription for high inflation has been to raise interest rates, which the Fed did do initially, but they've been on a pause. There are some economists who believe that inflation is being driven by parts of the economy that are not as interest rate sensitive. And so raising rates may not do everything to lower inflation. It's not necessarily the consensus view, but it's plausible. Most economists actually believe that inflation is going to trend back down to its 2% target within the next 12 to 18 months, even if monetary policy remains neutral. But I'll just say they believed that for the last 4 years, and here we are. So it's possible that the Fed decides to take a more aggressive action to try to contain inflation by raising interest rates. So that uncertainty is causing a bit of volatility in both equity and fixed income markets. I want to spend a minute talking about the long-term drivers of economic growth because I think it's important to understand what's going on in the economy right now. If you look at the right side of the page, you can see economic growth rates by decade since 1950. And economic output is determined by the working population. So, how many people do you have producing output, and how much output do you have per person? How productive are they? And we saw really big productivity gains after World War II as automation and technology made workers more productive. And then over the next several decades, you saw healthy growth in the workforce as women entered into the labor market. We saw the US attracting working immigrants, and this was balanced by trends of people coming into the workforce a bit later. So, higher education actually slowed the growth in workers as more of them went to college and grad school. But you can see from 1950 until about 2000, we had 3 to 4.5% growth rate in the economy, driven by more workers and productivity gains. And then economists started to study the problem of lower productivity. Why was the working population less productive in the wake of such amazing technological advances, such as personal computers for workers, iPhones, email, the internet, all of these things that should be making us more productive? And I don't have a great answer for this. I looked at it a little bit in grad school. I suspect some of this has to do with the way it's calculated because you back into the calculation by looking at total output and the number of workers. But this problem of productivity growth was considered the main problem. And now we have AI, which seems to be a big part of the answer to the productivity growth problem. If you look at the bottom left chart, you can see the amount of capital spending by category, and spending on equipment as a percentage of GDP has bounced along between 5 and 8% since the late 1940s. Spending on structures has been between 3 and 4% for decades, but countries that have really seen an edge in growth are investing in the future. And that shows up in the spend on IP and R&D, so intellectual property and research and development. So the new ideas and technologies coming out of companies, in addition to raising the quality of life from drug discovery and other research endeavors, a lot of this research and these patents are working to solve the productivity problem. Because we have another problem now, which is very clearly demonstrated on the top left of this page. The working age population is not growing. And this has been true for a long time. And one of our competitive advantages as a country is that it's a very attractive place for workers around the world. And so we've been able to attract talent from everywhere. And if that ceases to be the case, whether we prohibit people from coming and working here or they just don't want to because it's less attractive to do so, that will have an impact on growth. And so increasing productivity per worker is even more important in an environment where the working age population is not growing. There are a lot of ideas about how AI and robots are going to impact this. I just watched a long interview with Elon Musk, and he has some very grand ideas of what the world's going to look like in 10 years. But in any situation, I believe it will be disruptive, but it gives you an idea of how we might be able to get back to stronger economic growth, which is paramount if we're going to make good on our public debt and decrease the deficit. So these kinds of factors are kind of going on in the background, and they also have an impact on what's going on in our fixed income markets and how that 30-year bond is reacting. So I wanted to share that with you. With that backdrop, global equities are performing very well. The chart on the left shows the returns in different countries to local investors as well as to US investors. So, for example, the Japanese stock market is up 20% year to date. And when you take those gains in yen and you translate them back into dollars, the return to a US investor has been 16%. Notably, we are seeing a divergence within emerging markets, with India and China down on the year, and Taiwan's market up 65%, South Korea's market up over 100%, all led by big tech gains. We have seen an increase in yield across the curve and across sectors in the fixed income market, and yet fixed income returns have still been modestly positive for the year. And that's because the starting yield really matters. So remember that interest rates and the price of bonds move in opposite directions. When rates go up, the price of the bond goes down, and vice versa. However, the return for that bond is made up of both price movement and the interest rate payment or coupon. And so with higher starting yields, the interest rate payment does offset a lot of that negative price decline. So we're in a really good spot with fixed income where the downside is quite limited, even if we see a modest move up in interest rates, while there's a lot of room for price appreciation if we do start to see interest rates fall. And if rates stay the same, that starting yield is the return. So around 5% for investment grade corporate debt with a pretty positive risk profile. So if you have excess cash sitting in a bank account, sitting in savings somewhere, fixed income does look pretty attractive here. I'll wrap up with a check in on real assets. I've already mentioned the decline in energy prices for the quarter. Gold got a lot of attention last year for its huge run up in price, and it's giving some back this year. The precious metals index, which is mostly gold, there's some silver in there, was down about 15% for the quarter, down over 7% on the year. REITs are having a good year, up 15% year to date, up nearly 11% for the second quarter. And we've been talking about the positive fundamentals for many real estate sectors for the past couple years, and finally sentiment caught up. So office space has rebounded, particularly Class A space, where rents are much higher than kind of pre-COVID. And have also been improved occupancy in retail, life science facilities, and of course, data centers. So all in, a positive quarter for a diversified portfolio. So that's a quick look at the quarter. If you'd like to further discuss any of this or how it impacts your own financial plan, please reach out to your relationship manager. We'd love to hear from you.